In this video, I'm going to speak about three stocks from late Shri Rakesh Jhunjhunwala's portfolio. And the reason I'm speaking about these three stocks is because these three stocks are down by between, let's say, 25 to 50% in the last few weeks. What is driving this correction? What is the business model of these companies? What are the fundamentals, valuations? I'll try and cover and give you everything that is possible. Only request is that please don't take these as recommendations, because just because a stock is down by 25 to 50%, it doesn't mean we need to go and buy that stock. The intent is for you to become aware about these three companies that is there in late Shri Rakesh Jhunjhunwala's portfolio. With that, let me just go to Rakesh Jhunjhunwala's portfolio as of now and show you the details. First thing is that in September 2025, they have added 4 stocks in their portfolio. They have increased the exposure: Federal Bank, Titan, Canara Bank, Tata Motor, PV Limited. It doesn't mean that we need to add them. Please never follow anybody blindly. But let me now come to their holdings. So first, the largest holding we all know is Titan Company. This is what made late Shri Rakesh Jhunjhunwala's portfolio swell to great value, right? This is the number one company, followed by IKS, which is Inventurus Knowledge Healthcare company. Again, I'm going to talk about that company. You can see the entire list here. If I scroll down, you can just read the names. Again, none of these are recommendations. Please make sure you are learning from this video. Although I'm a SEBI registered research analyst, my intent is to teach you about these companies so that you understand what's happening in the stock market. Do not take these as recommendations. Now, having said that, let me move to the first stock that I want to cover. It's a company called Inventurus Knowledge. So this is company which is IKS Limited. And this company, if I give you some background, so for example, if I show you this statement, I was reading their annual report from 2025, and late Shri Rakesh Jhunjhunwala made a very, very bold statement about this company. Let me read it out to you. One day you will see that IKS will emerge as an iconic company, not only in India, not only in America where its business is, but also worldwide. This is a very, very big, bold statement that Rakesh Jhunjhunwala made long back. Okay, he actually invested in this company in a very, very early stage. In fact, if you read their non-executive chairman's message here, he invested in this company long back and around $5 million, right? And during its IPO that came out in December 2024, at that time, they made almost 530x returns. Now, again, please do not get me wrong here. It doesn't mean that we are going to make that much money, right? Point is that he believed in this company and he held on to this company for a long, long period of time when this company was just starting off, right? And this company got listed at around 1329 back in December 2024 as its IPO came. At that time, 43% premium is what it got listed at 1900 rupees level. And this was oversubscribed by around 53 times. This is one of the good IPOs in my view. Given the circumstances we have right now in Indian stock market, where companies like Lenskart, they are asking for 200p and whatnot. I know there is a big controversy around the valuations of that company. These are the IPOs that are really, really good IPOs in my view. Now, let me walk you through why I think this company is a very, very good company. Again, not a recommendation, but you need to understand the business model of this company. Actually, before I go to the business model of this company, let me show you the price chart. So this company made an all-time high of around 2151 back in December 2024 after its IPO listing. It has come down now, and at the time of recording this video on 14th of November, I can see it's down by almost 25%. What is driving this correction? What is the business model of this company? I'll talk about that in a minute. Right now, if you look at the market cap of this company, around 27,000 crores of market cap. It's a small cap company. Can it turn to a mid cap or large cap, let's say 8 years, 10 years down the line? I'll talk about the total addressable market in this particular space and how this company is progressing right now in terms of financials, right? I'll come to that in a minute. But let me first speak about the business model, and I'll only take 30 seconds to explain. I'm not going to go into deep details about this particular company's business model. Just imagine Zomato, right? What is Zomato's business model? They have a software, and on that software, they bring restaurants and they have customers like you and me. Restaurants serve these customers, but Zomato manage the software and manage the entire operation. So it's not just a software company, it's a software plus operations company. Exactly, this is how IKS also works, but what their customers are and what the domain is very, very different. So they work for clients in United States primarily, right? And the clients are big physicians or healthcare chains. Okay, they have a software, so they bring these doctors, healthcare chains, etc. on this platform, and then they have on the other side patients. These patients need to consume the services from physicians, but in between, by implementing this software, along with the operation. So they have the staff that support this entire process. They handhold these physicians, for example. What they do is that they try to avoid the manual work, right? So when the patient comes and visit the doctor, there will be a lot of manual tasks. Given the fact that US healthcare is highly regulated, everything need to be documented. It's not like what we have in India, right? That you go to a medical shop and get antibiotics. It doesn't really work in US like that. So there is an entire process. So pre-visit, during the visit, post-visit, in between the visit, all these operations they are trying to automate, and you can see the level of optimization and automation here. For example, scheduling of the patient's visits, right? And this is, again, as I said, it's not an IT company. It's not a software company. It's a software plus operations. So they have staff on the ground who works very, very closely with the physicians, the healthcare chains, and through that software plus operations combination, they are delivering services to clients. This is a very, very unique business model. Not many companies have this sort of model. More companies may enter into this space, but as of now, this is broadly their business model, and they're charging these clients on the basis of outcome. For example, if a doctor has given a prescription, and if that needs some documentation storage, for example, all of that is charged per prescription. So their services are primarily outcome driven. Again, there is no slide that I can present to you, but I was reading their annual report and that's what I found, right? Which is very, very good. Now let me talk about the financial health of this company or the fundamentals. What you see, very, very clear picture. Every single year since 2016, their revenues have gone up. It's like a consistent compounder. Profit wise, if you see, 32% of PAT CAGR in the last 9 years of the time frame. Only 1 year, 2018, that's where the PAT dipped. But other than that, if you exclude that year, almost every single year their PAT has gone up. If I talk about their latest Q2 results that came out just recently, ROE, which is return on equity, is standing at around 32%. Very, very healthy numbers. If you look at the EPS, has gone up by around 59% year on year, 19.2% Q on Q. Very, very good fundamentals is what I see. If I talk about the cash flow, operational cash flow, OCF, free cash flow, FCF. Again, if you don't know these terms, my humble request is that please understand these. I run a community on YouTube where I talk about various assets on a simple language so that people understand it. If you're not yet a member, you can consider subscribing, or even if you don't want to become a member, that's okay. Please go and read about these terminologies on Google at least so that you understand what they mean. Now, coming back to the OCF and FCF, healthy growth here, 92% growth YOY on OCF, and free cash flow is around 124% of growth. Very, very good numbers. They've been using this cash flow to pay off the debt. As you can see, the debt has been coming down. It's not a debt-free company as yet. As of 30th September 2025, around 412 crores. This is in millions. So 412 crores of debt is what the company has on the books. Now, what are they going to do about this debt? Company says that by fiscal year 2027, they are going to use this cash flow and they are going to become debt free, which is very, very good in my view. Now, coming to, you might have a question that Rahul, there is a lot going on in US market. Their clients are in US. What about tariffs? What about H1B visas? What about the big beautiful bill tax that Trump brought? So the management clarified in the October con call that tariffs have no impact whatsoever. H1B visas have no impact. They do not have any staffs going from India to US on H1B visa staff. All three parameters, company management categorically said that no impact whatsoever. So I don't think we should worry about that at all. Now you may say that, Rahul, what are the future prospects of this company? What is the guidance? So the management does not give any guidance, future looking guidance for what is the revenue growth likely to be, what is the PAT growth likely to be. Therefore, we can't do any forecasts here. But what I want you to know is about this company is the total addressable market, TAM. Another terminology that you should be very familiar if you're doing analysis about stocks. So if you look at this, overall, $5 trillion is the market in US healthcare. This is not their target addressable market. TAM for them is around $260 billion. That is growing at a healthy rate of 8%. No cyclicity built in that. But actually, if you talk about the outsourced TAM, which is out of this $260 billion, it comes out to be around $34 billion. That is growing at around 12%. And if this company continues to grow faster than the 12% rate, which we have seen in the financials that they have been, that means that they're going to gain market share continuously. And that's where the future prospects, in my view, are looking very, very good. Also, one thing that I forgot to talk about, let me just go back to the chart here. What you note is that in financial year 23, 24, 25, the buildings have gone very tall, right? Why this growth? I was reading their annual report. They have acquired a company in 2023, if I'm not wrong. The company's name is Acuity, I think. It's a US-based healthcare company, and the company has around 700 plus clients. And this company now, IKS, is trying to do cross sell to those clients as well. That's why if you see 24-25 had a huge growth rate, and that's what I could make out from their annual report. Anyways, coming back to their future prospects, I've talked about the TAM, I've talked about their market position. Now, if I talk about the valuations, let me quickly talk about the valuations. If you look at the PE ratio of this company at the time of listing, it was at around 99, and one could argue it's a very, very high PE to pay. Right now, it has been coming down, compressing. Right now, it is at around 45. You might still say that, Rahul, you know what, this is slightly higher. That is a call that you can make, right? So a company that is growing at more than 20% of growth rate, would you pay a PE of 45? That's a question you need to ask. If you look at the PB ratio of this company, again, it has been very, very high if you go back to June, but it's come down to almost like 12. If you look at EBITDA multiples, that also is now at around 30. It's still on a higher side if you ask me for a normal company, but it has been coming down, it has been compressing. In my view, this sort of a stock is a stock that is a compounding stock. You don't buy these stocks for like a year or two. You would have to really look at a very long time period, and that's what Rakesh Jhunjhunwala's portfolio is showing. They still hold that company, and if I just go back to that chart here, they still have around 49.3% stake in this particular company. Very, very solid, although the stock has been falling. I hope you like this analysis. Request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to do a lot of research for you at zero cost. With that, let me move to stock number 2 now. Let's now go back to Rakesh Jhunjhunwala's portfolio and have a look at another stock. So the stock I'm going to pick up now is Concord Biotech. It's a pharma company we all know, and this company is holding as of now in portfolio is around 3,734 crores. So huge holding at number 4th, right? Now, if you look at this company's price chart, first of all, this company has come down from its all-time high that it made in September 2024 at around 2629 to almost 1458 level at the time of recording this video, which converts into 45% of fall in the price. Why the price is falling, I'm going to talk about that. But more importantly, what is unique about this company, Concord Biotech? The first thing that you need to understand is this company is into fermentation-based APIs. Fermentation-based API is a specialized skills, not a lot of pharma companies can get into it. It needs a lot of specializations, right? And if I talk about the company's market share, there are 5+ molecules where it holds 20% plus market share. So it has sort of developed niche in a particular few fermentation based APIs. Now, if you're familiar with pharma companies, API is the intermediary. For example, Dolo is a final product, Dolo that we take, but the intermediary here is what? Paracetamol, right? So that's how they are into APIs. Now, coming back to this company's overall revenue breakdown, API contributes around 75%, as you can see here, while around 25% is coming from their formulation, which is the final products. And if you look at domestic versus export, this is where a lot of problem is coming for the company. Domestic sales is around 59% as of Q1 FY26, and export is around 41%. Of course, USA is one of the big market for this particular company. If I talk about the historical fundamentals of this company, very good growth rate in terms of revenues, 18% 5-year CAGR. If you look at EBITDA at around 12% 5-year CAGR. If you look at PAT, around 12% of 5-year CAGR. Of course, this company has not delivered, let's say, 20% of PAT growth, but last couple of years, if you look 24-25, PAT growth has been very, very impressive. Now, if I talk about the companies, for example, margins, gross margins have been coming down historically, which might be a pain point for the company, from 81% back in 21 to almost 74%. EBITDA margins have been slightly fluctuating from 53% to 37 to now 42%. PAT margins around 30%, which is very, very healthy in my view. Return on capital employed is around 27% as of FY25. So I'm reading these data as of FY25 and giving you a trend whether the margins have been compressing or they have been expanding. I'm happy from a PAT margins perspective. Gross margins, yes, there is slightly red flag here, but overall, if PAT margin is improving, I'm very happy with that. If I talk about the net debt to equity ratio, company is debt free. FY25, there is no debt. From a net debt to equity perspective, it's 0. Net worth has been going up. Working capital, of course, moves up and down, so not really worried about that. Now, the question is, why is this company's price have come down to almost 45% from its all-time high? See, there could be various reasons here, but few reasons that I could spot from a fundamental perspective is that in Q1 FY26, companies' revenues declined by 5% and their PAT declined by 26%. And just yesterday, they declared their Q2 results, and there also revenue now declined 20% and the PAT have declined around 34%, right? Now you may say that, Rahul, this is a falling knife, right? Because the fundamentals have been deteriorating. Maybe possible. It is absolutely possible. But look at the reasons why this is happening, and we try and understand whether this could be reversed in future. That's how you basically analyze your beaten down stocks. What you see is the company is giving three key reasons for the challenges the company is facing right now. One is delay in renewal of written confirmation from CDSO to supply in European Union. They are not able to supply in European Union because there is a delay from our government, New Delhi, right? Can this be done, let's say, in the next few weeks? Of course, it will get done in my view. So they will hopefully start selling again in European Union, let's say in the next 1 to 2 quarters. I'm not worried about that. Look at the procurement patterns from US customers. This is what I think they are around 39% revenues were coming from exports. Of course, there was uncertainty around tariffs. We're going to have a deal at some point in time. Hopefully, that should sort itself out. Again, it might be a quarter away. I don't know how long it may take. And third is the government tender on hold in Middle East, right? Again, if you look at all these three problems, to me, they seem very temporary, right? In fact, what their management was saying for the Q2 results that came out yesterday, he's saying that these are the problems that we're facing right now, but he believes that the sales will be recouped in the subsequent quarters. Please understand, if the company's sales have been down now, what's happening is that could they regain these lost sales? You know, that's where the opportunity is, not the problem. This is the current problem, but could it translate into opportunity in, let's say, Q3, Q4 or Q1 of the next year? This is where the patience comes into picture. The stock is beaten down. All of this bad news is factored into the stock price, because when people see revenues declining, profits declining, the sell-off happens. That's what has happened primarily. That's why it is a beaten down stock. Now, again, can it rebound or not? Only thing that we have is management's word here, right? Now, whether we trust the management's word or not, it really depends on your ability, your appetite, your risk appetite. Again, I can't say whether you go and buy this particular stock or not, right? However, if you look at the long-term view, just forget about the transitory period that is going on right now. Management says that we want to hit 25% of CAGR growth in our top line revenue. Well, right now they're down in the last 2 quarters. Can they hit it or not? It's a question out there. Management is, of course, making a bold statement here. This is from the Q1 FY26 earnings call. Q2 earnings call, the PDF is not yet there, so I could not take the screenshot. Anyways, now coming back to the final point that I want to make about this particular company is the PE ratio. Valuations, if you look at last 2 years, median PE has been around 53. It's come down to rock bottom at around 42, right? From a PE ratio perspective. PB ratio, if you look at that, is also come down to almost bottom now at around 8.4. If you look at EBITDA multiples, that also is at bottom, right? Now, one could argue here that because of diminishing fundamentals of the company, the valuations have come down. If the fundamentals go back up to its place, the valuations are likely to go up. Now, again, not a recommendation that you go and buy this company. This company is a small cap company, very, very risky. 15,000 crore roughly is the market cap. But as I said, there is something unique about this particular company. Long-term future might be good. Right now, they are going through the storm. They are sailing through the storm. Can this company survive? I can't make any comments. Otherwise, it'll look very futuristic, right? But hope you like this analysis. Request you to hit the like button. Let me know in the comments. It's simple. Thank you. Also, if you want to get certain deep analysis like these for stocks, mutual funds, ETFs, consider joining my YouTube community. That's where I practically teach, bring you a lot of insights from the market. You become a better investor. I talk about a lot of emotional coaching as well in terms of when the market is falling, what do you need to do? You don't need to panic. Those are the things you need to know. The feedback of this community has been excellent. Go to my channel, find the join button and be my guest while I move to stock number 3. Let's now come back to late Shri Rakesh Jhunjhunwala's portfolio, and I'm going to discuss one of the other stocks is called CRISIL, right? Around 1751 crores of holding as of September 2025. A stock that I personally like. Again, like doesn't mean that I go and buy this particular stock. In fact, full disclosure that none of the 3 stocks that I've spoken about so far are in my portfolio. They are not in my portfolio, right? My intent is to teach you. That's my intent. I have been looking at a lot of companies and I pick up my companies based on a lot of parameters. But now coming back to CRISIL. Have a look at my screen. What you see here is that the company from 2020 have been compounding at a very, very good growth rate. Right now, it's declined by almost 30% at the time of recording this video, from all-time high of 6654 to around 4613 at the time of recording this video. What is causing this fall? I'll talk about that. But before that, I really want you to look at the financials of this particular company. Fundamentally, if you look at from 2013 onwards, not even a single year I can see here where the revenues have dipped. Actually, there is 1 year to 2019, very marginal dip. But look at how the revenues have been growing every year consistently. Okay, it's sitting at all-time high revenues. Look at the profits, how consistently they have been going up, sitting at all-time high profits. These are the stocks which have very limited risks from a business perspective. Again, I'll show you the business model of this company, but that's why these are called consistent compounders. Why is it so? Why is the company have very limited risk? Let me talk about the business model of this company. So this company, for example, if I talk about the company is into two business segments. One is the rating services, as you can see in green here, around 28% of their revenues come from that particular department. And second is the research, analytics and solutions, which is where around 72% of their revenues come from. Now, rating services is what you might have heard about bonds. I've been speaking about corporate bonds on my channel, right? These bonds get rated by companies like CRISIL, and they charge a fee to the bond issuing company. And these bonds are not just by NBFCs, they are also issued by the banks, right? So more the bonds are raised by banks and the NBFCs, more business are they likely to get. That's part one. Part two is the research, analytics and solutions, which is where they're doing a lot of research, publishing, articles, analytics, research about companies, themes, etc. And they are earning good money from there. The reason I say this is a very limited risk business is because they don't have plant, they don't have machinery. What is their moat here? It is the intellectual capabilities of doing research. Not everybody can do it. Entry barriers are high. I can't get into research full-fledged like what CRISIL is doing. There are a lot of regulations, etc. I mean, if I wanted to get into research, I definitely would do. But my point is very simple. The limited risks are because of they don't have any on-ground operations like logistics, plant machinery, all that, like a pharma company would have, or a manufacturing company, any other manufacturing company would have. The risks are limited, and that's why as long as the economy is doing well, they would do well. Now coming to segmental profits here, 44% profit is coming from rating services. So more profit is being generated by rating services, and research, analytics and solutions, that's where they're getting their 56% of their segmental profit. Now coming to the geography also, if you look at, very well diversified, not relying on one single geography, because this company is a subsidiary of S&P, and if you look at India, Europe, North America, they are well diversified. Now coming to the cash flow of the company, I want you to pay attention here. If you go and read the annual report in 2024, they haven't really published 2025 annual report, at least I could not find it. But if you look at the cash flow from their operational activities, very, very good number. These are in lakh, so 78,000 lakh in 23, 76,000 lakh in 24. You can convert that in crores, but point is, they are generating a lot of operational cash flow. What will the company do with this operational cash flow? They can go and acquire a lot of companies, and that's what they have been doing precisely. Go and read about their announcement and you will find that they have been acquiring a lot of other research companies. Now coming back to why is the stock down now? Okay, here is the summary slide that you need to know. If you look at the last couple of quarters, 3 quarters, what's been happening in Indian economy is that the bond issuance quantum in terms of rupees in billions have been coming down. It's declined by 32%. And that has directly hit their revenue, or at least the sentiments by the investors, right? Why is that happening? Bank credit growth has been declining in India, right? Our economy has not been doing very good. It was at peak somewhere in 23, but since then the credit growth has been declining. Credit growth is what? Simply the loan rate at which the banks are giving loans. If the loan rate is coming down, less loans are being disbursed, then bank is not going to raise money through bonds. As simple as that. When bonds are not being issued, companies' revenues might not grow at a very high rate. Still, it has been growing. If I show you the data for 9 months of FY26, if you look at this data here, still 9.4% growth rate from a 9-month perspective, quarter on quarter, 12.2%. It's not that the company has stagnated, but maybe it was growing at 15 to 16%, slightly come down. Also, sentimental impact is more larger here because investors know exactly what is happening in Indian economy, that the bonds are not being issued at a rate it was earlier. Therefore, they might see some slowdown coming up, and therefore people are slightly panicking, or the stock is under pressure. The management of the company says that it's all about the fundraising in a particular market. If the economy is doing well, capital is moving in terms of funds being raised, in terms of mergers and acquisitions, all of that help this company, right? Now, I don't know how the 26 will span out, how the 27 will span out, but the companies like these are consistent compounder from a fundamental perspective. Look at the valuations right now. What has happened to valuations? So if I go and look at the PE ratio of the company, it's come down well below the median PE of 48.8, and last 3 years median PE, it's now at 45. In my view, these median PE ratios are good valuation. It's not going to go down to 20 PE. In my view, again, things could change very drastically. If you look at the profit to book here, again, almost bottom here, 12.1. Could it go further down? Yes, absolutely possible. Everything is possible. EBITDA multiples, if you look at it, it's come down to almost median PE, median ratio, which is 32.5. It's come down to 29.9. So from a valuation perspective, it has calmed down. and we all know the reasons for it now. Please go and research about this particular company. It's a very, very good consistent compounder, not a push that you buy. My push is for you to learn. And if you want to learn, please subscribe to this channel. I've been talking about various assets. Will teach you more from a data backed analysis. I don't give you my opinion. I show you the data, and you are the ones who make decisions and get benefited. That is up to you. If you want to get practical content on a daily basis, you can join my community. Feedback of this community has been excellent. Simply go to my channel, find the join button and be my guest. With that, I hope to see you in my next video. Until then, keep rocking.